This episode is sponsored by independent Swiss luxury watchmaker Ulysse Nardin. Ulysse Nardin has continuously reset the boundaries of watch engineering and design thanks to its long-established technical excellence and its unconventional approach to watchmaking. To find out more, visit ulysse-nardin.com. That's ULYSSE-NARDIN.com. Ulysse Nardin.
You're listening to The Luxury Item, the podcast on the business of luxury and the people and companies that are shaping the future of the luxury industry. Here's your host, Scott Kerr.
Switzerland's watch industry recorded a bumper year in 2022, and so far this year, continuing economic headwinds have not blown it off course. One of the most impactful international retailers that has been the home to a selection of the world's finest Swiss luxury timepieces is Watches of Switzerland. The Watches of Switzerland Group is the UK's largest luxury watch retailer, operating over 193 showrooms across the UK, US, and Europe, including 80 monobrand boutiques on behalf of brands like Rolex, Breitling, Omega, Audemars Piguet, Tag Heuer, and others, as well as its e-commerce presence. Watches of Switzerland went public on the London Stock Exchange in 2019. My guest on the luxury item is David Hurley, Deputy CEO of Watches of Switzerland Group. He also serves as President of Watches of Switzerland Group North America. Since joining the company in 2015, Hurley has established the Watches of Switzerland Group as the dominating leader in the U.S. market. Under Hurley's stewardship, the brand acquired Mayors Jewelers in 2017 and went on to open its first Watches of Switzerland U.S. flagship in Soho, New York in 2018. In the U.S., the group now operates 7 multi-brand boutiques, 13 monobrand showrooms, 12 Mayors locations, and 3 Betteridge doors with the plans of continued expansion. Welcome to the luxury item, David.
Thank you, Scott. Great to be here.
Thank you so much for joining me. It's really been an interesting few years for Swiss watchmakers. The Swiss watch industry earned more than ever before in 2022. Global demand for Swiss luxury timepieces spiked during the pandemic and has continued to steamroll despite economic headwinds. The first 5 months of this year is still trending up overall. Some of the CEOs of the Swiss watch brands that you partner with at one point were seeing the watch sector slow down after this unprecedented boom, but they were still cautiously optimistic. So what about you?
Well, I'm always a glass half full person, Scott. I'm actually very fortunate in terms of when I came into the industry. I came in kind of late 2015 and was working on business development, and we only came into the US. One of the kind of deals I was working on with the acquisition of Mayors in October of 17, and then we took over the retailing in the Win in November of 17. And it was kind of be good or be lucky. At the time that we came in, it seemed like the businesses that we acquired, sales went up 10 or 15% almost the day that we acquired them. And that was nothing to do with us. That was the positivity in the economy at the time. And since then, you're right in saying that the Swiss watch market in the US has gone from strength to strength, now becoming the biggest market in the world. And maybe there was a post-COVID benefit to that as well. And that growth has been pretty exponential. For us as a business, we went from 120 million in sales in our first year to over 700 million dollars in our last reported year. And a lot of our brands have been growing 50, 60, 100% year on year. And that was bound to slow down to a more normal pace of growth at some point in time. And I think we're starting to see that now. There's definitely a little bit more nervousness out there. And of course, people hear different things when you say slow down. Sometimes people say slow down and you think, wait, that means the market is going backwards. And that's not necessarily the case, but it is growing slower than it was, but off of very, very strong year on year and 2-year numbers. When we look at we're originally a UK based business. And when we look at the UK, we kind of compared a lot of things UK versus US when we came into the market. And one of those things that we compared is just kind of the sales per capita, and started to compare it, timepieces other luxury categories. And so, we look at something like hard luxury accessories, so handbags, etc. And the US is kind of 6 times the size of the UK market, and luxury jewelry it's 5 times the size. And for luxury watches, it's somewhere between 2.5 to 3 times the size. So we're still pretty bullish that the market here is going to continue to grow. But that's dependent on a number of things. I mean, first of all, the economy here it still continues to be quite strong, certainly stronger than our home market in the UK. It's dependent upon the brands continuing to invest in this market, and I think they are, and they're invested in a distant way. And it's dependent upon retailers like us continuing to invest and grow. And again, when we look at other luxury categories here and look at the groups like LVMH and Kering, they're still investing in a big way in the market. But the kind of rampant demand that was there, and maybe some of the hype that was around timepieces, that just can't last forever. And you've got to continue to invest in sustainable growth. And that's something that we certainly believe in. And that's kind of been a characteristic of what we've done both in our UK and US markets. So overall, we're optimistic, but yes, certainly this year I would see a slower rate of growth in the US market.
And judging by the revenues alone, everything seems rosy, but at the same time, volumes have been declining. Exported watches from Switzerland went from about 28 million in 2015 to close to 16 million last year. That's about half the volume. What do you attribute to that kind of volume loss?
Well, I think the Apple Watch is and smartwatches in general are definitely a component of that, and I think it's hard for the Swiss watch industry to compete against that kind of technology at that price point. There's obviously Swiss watch brands that have tried to go in and do smartwatches, and some of them are doing it well. But you're talking about, the investment in technology is huge. And then the ability to be able to link to the iPhone is such a huge thing. But I see the Apple Watch as a really positive thing, and smartwatches in general. I'd much prefer to have someone wearing an Apple Watch on their wrist than no watch at all. And I think, Scott, what do you have? Do you have an iPhone? Do you have a Samsung? What do you have as a phone?
iPhone.
iPhone. Well, look, I've got an iPhone as well. I've got the latest version of. I still have to charge it twice a day. I bought the Apple Watches as well, just like everybody else. There's a new iteration out every year, and they become redundant pretty quickly. And I think people more and more so are appreciating, buying, predominantly Swiss timepieces and something that can last a lifetime. And at the same time, they can wear a smartwatch or a Fitbit or the Aura ring or whatever it is, basically. So, you've got two wrists basically, so you can have one on either wrist. I don't know that the kind of volume at the lower price points will ever come back. But you've got other companies that are proving that they can, if they do something innovative, then they will generate huge demand and huge volume. And if you look at what Swatch did in their collaboration with Omega and the excitement around that, with huge queues outside the stores. And that was a boost not only for, obviously for Swatch in itself, and that they were a bit of a game changer at a point in time, just like the Apple Watch,
Right.
But actually had a positive boost to our watches as well. We saw, Omega is a very strong brand for us anyway, but we saw stronger sales in the Speedmaster immediately after the launch of that watch. And I think that was a great opportunity to excite people about Swiss timepieces at a different price point. But whether the volumes are ever going to get back in those areas, I don't know. I think the Swiss watch industry, and I've only been in it for a short time, but they've gone through other crises and they continue to pivot all the time. But I think they're focusing more on higher price points. And for us as a group, in particular in the US, in the main, we're kind of focusing on kind of $1,000 and above, which is already a significant sum of money to spend on a timepiece.
One of the hottest topics in the industry over the last 2 or 3 years has been the scarcity of some luxury watch models, which were selling at way over retail prices on the secondary market and huge waiting lists, an oversupply of others, which are being discounted on the gray market. With the seismic shift in selling watches since the pandemic, what do you think is the biggest challenge facing retailers today?
Yeah, I mean, first of all, just on the watches, the luxury watch models selling way over price. Obviously, there's been a little bit of a drop on that for what were the hottest models, Scott, and I think that's a really positive thing. I think some of the prices were just going way out of sync when you're having to pay 3, 4 times over retail for certain models. I think it starts to become a bit of almost emperor's new clothes, if that makes sense. I'm not going to pay that much for that. That's just kind of crazy. And I don't know at the very, very top end of those prices whether they were real or not. I mean, we have a significant vintage, but also pre-owned business, and we do well. But we kind of shied away from some of those models that were just completely crazy. And I think probably, encouraging people in some ways as well to invest in timepieces, maybe for a different reason, because they could get a quick profit flipping the watch, etc. So the fact that that's softened a little bit is, I think, generally a good thing. We still see, it hasn't, that dip in those secondary prices hasn't affected the demand for any of the timepieces that we have. In terms of some of maybe there is obviously other brands that maybe have been oversupplied or on the grey market, but I do think that the majority of the watch brands over the last 3 to 4 years have done a very good job in controlling that and reducing amount of timepieces that end up on the grey market, or just closing down those doors that maybe were fulfilling the grey market. So that can only be a good thing. In terms of the kind of seismic shifts in selling watches since the pandemic, I mean, some of it was happening before the pandemic. When you look at the kind of the super high demand brands, every year, I would say the majority of retailers were probably selling more than they were receiving on an annual basis, and then suddenly ended up in a scenario where there was next to nothing actually physically in stock in the stores. And that certainly has created some frustration on the part of the clients, and understandably so. I think, some of the brands, Rolex, for example, they rarely make public statements, but they've been clear that, scarcity is not a strategy, but that, they can only make so many timepieces to a certain level of quality. And so, one of the major changes that, we want to do as a company, and I think a lot of other retailers is obviously make sure we treat every client with respect, try and manage and ease that frustration on the part of clients, and get back to them on a regular basis, and kind of keep that dream alive that they can get the timepiece that they're looking for, which we're in a wonderful position. We get to make a lot of people happy on a daily and on a weekly basis. We can't make everybody happy, but we try and, for want of a better term, Scott, kind of share the love, and and make sure that we're not selling 10 high demand timepieces to one client. We're trying to sell them to as many as possible. We have our own internal targets to make sure we're selling to new clients as well that haven't purchased with us yet for some of those high demand timepieces. So that's a part of the business that's possibly changed, where for a certain percentage of the business in the past you had great salespeople, and now you really need good customer service people that take these requests very seriously, get back to the clients on a timely basis, and treat every one of these requests with a lot of respect. So that's one significant change that's happened. Some of it even pre-COVID as well. I think the other major changes that are happening are just things that are happening in every luxury category or across, just in dealing with consumers. I mean, there's the luxury of time with all of these kind of productivity tools and the ability to do Zoom calls and Teams calls, and you've got your iPhone, and It's I remember the original pitch from Steve Jobs of, well, it's your phone and it's your computer and it's everything in one device. Yet we still seem to be struggling to get things done on a daily basis. And so I think everybody, including consumers, want quicker answers, more instantaneous answers. And, a huge amount of the people that come into our boutiques now, having come into the boutique, afterwards, a lot of the communication is via text and WhatsApp versus phone calls. And it's really the client that determines what that interaction is. And so there's an expectation of a faster turnaround in communication and getting back to people than there possibly was 2-3 years ago. So the luxury of time, I think that's really important to make sure that when people come in and after they've determined that they want to purchase a timepiece, that you just make the process as seamless as possible. So that's probably the kind of two major changes that are there. I mean, I think also just in terms of how you advertise and how you market stuff today as well, I think there's significant changes there, again based on human behavior. I've got a friend that works for Microsoft Bing, and he was telling me over the weekend that now the attention span of a human is now officially less than a goldfish.
Goldfish?
That it's there's something like that. It's they track it using Instagram and TikTok and just how quickly people swipe through stuff, and the average viewing time is something like 9 seconds or 8 seconds. So capturing people's imagination with marketing and editing and changing that. So, maybe sometimes the traditional billboards don't work. And so that's another part that's kind of changing. You've got to change and be where the consumers are. And
Right.
so, maybe that was Instagram at some point in time, it'll be TikTok as well. And just capturing people's imagination. You've got to constantly come up with innovative ways to market and to reach out to clients.
So you joined the company in 2015, and last year you were promoted to Deputy CEO of Watches of Switzerland Group, and you also serve as President of Watches of Switzerland Group North America. You were appointed on the heels of Watches of Switzerland releasing a 5-year plan for expansion. Can you share some of the key strategic elements of that long-term plan?
Look, I've been very fortunate in my career in Watches of Switzerland. First couple of years is kind of responsible for business development. In fact, the first year, kind of first full year, every deal I worked on, Scott, fell apart. So at the end of the first year, I'd really accomplished the square root of nothing. And then from there, but it's just sometimes these deals and these acquisitions don't come off, and it's the effort that you put in. The second year, we came into the US market with the 2 acquisitions I talked about, Mayors and taking over the retail in the Win. And we signed for 2 locations in Hudson Yards and Soho that became a really great success. So was delighted to be appointed as a deputy CEO. And let me explain some of the reasoning behind the 5-year plan in the first place. We'd gone public a couple of years before that. At the time, we'd really just entered the US market. And in some ways, that was being looked upon as a little bit of a risk at the time. There's plenty of UK companies that have come over here in different segments and haven't made a success of it in the US. And one of those companies is this big supermarket chain in the UK called Tesco's, and they came over to the US with this concept called Fresh and Easy. And when they said they were going out of exiting the US, and they wrote off a couple of billion, their share price actually went up. And then you've got people like Best Buy and other people that have gone to the UK and haven't made a success of it either, because they're strong local retailers. So that was probably the first question: was could we come to the US and make it a success? And as I said, whether it's some elements of what we did, plus an element of luck, plus the timing of when we entered the market, which sometimes is just outside of your control, that became a success in terms of the acquisitions we took over. Then the next thing was, well, can you open up stores, new stores in a new market like New York that's very competitive, and turn those into success? And fortunately, Hudson Yards and Soho, they've been a fantastic success. Not on day one, these things take time, but but they've really been we're delighted with how they performed. And then the next question was, okay, well, how quickly and how big can you grow the business, both in the UK, the US, and where else can you grow? So that was the thinking behind going out to the stock market, and we're on the UK stock market with the 5-year plan. I mean, the kind of top line strategy is, relatively simple. I mean, number one, sell more effectively, Scott, kind of grow revenue, profit, and the return on capital employed, because luxury is a very capital intensive business. And so that paid back is incredibly important, and you can't grow the business without it, and the stores get tired very, very quickly. I think one of the great things that our CEO, Brian Duffy, did when he came in 2014, at the time we were owned by a private equity company, was he kind of changed the strategy immediately and said, you've got to invest if you want to grow the business. And that's what they did, started to invest in the UK showrooms. So, we want to grow revenue and profit and the return on the capital employed. So that's just the kind of key financial metrics. We want to continue to enhance our brand partnerships and make them stronger and stronger. I mean, to be clear, Scott, we are, we are dependent on our brands, basically. We're kind of, we've often described ourselves as like the Sephora of watch brands. So, we have to continue to build those strong relationships, and that's highly important. The brands have to be represented appropriately. Their demands get higher and higher as the business gets more productive as well, as are ours. They want to be represented appropriately. Client experience, I think, just becomes more and more important on a daily basis. That was a significant part of the LRP as well. We've been fortunate with a few things in terms of we had a benefit a number of years ago for a point in time when Brexit was originally voted for. The UK currency dropped, and suddenly we became the cheapest place in the world to buy luxury timepieces, and that had a significant benefit to our business. And then, as you said, over the last 2 or 3 years, Swiss watches, I think, around the world have become, whether it was hype or great marketing or the investment of retailers and the brands itself, have continued to grow. What we've always done is, we want to have sustainable growth. That kind of growth is just not going to last unless you invest. So investing in the client experience, and so we have this kind of ongoing project in our business called Xenia. Xenia is the Greek word for hospitality, and it's about continuously trying to improve the client experience, because people have choices in terms of where they can shop, and it just makes a huge difference. That follow-up, as I mentioned earlier, we kind of retail in timepieces from $1,000 up to well over $1 million. We don't sell that many over $1 million on a daily basis or even on a weekly basis, but it's still a considerable sum of money, and you want to treat people appropriately, and we can always improve that client experience and the ability to surprise and delight. And so that's a major part of what we've been doing. And then just continue to do impactful marketing. We've done, particularly in the US, a lot of maybe slightly unusual marketing for a multi-brand watch retailer. We have our own head of creative in-house. We do a lot of our own in-house creative in collaboration with the brands, because sometimes the brand marketing that we get given, that we put on social media, that we use to advertise, has already been seen and sometimes has limited impact on our social channels. So we're trying to do more and more unique marketing ourselves. And, we want to kind of continue to leverage best-in-class operations. So we've got scale and size, and so we've been investing in that as well. And then the ESG and just has become a bigger area for every business, something that I think everybody has to be conscious of. And we have our own internal head of ESG. So, what does that all mean? We're kind of 2 years into our LRP. Well, from a sales and profitability basis, the investments that we've made acquisitions, all of the investments that we've done in improving the customer experience and marketing. We're kind of 2 years into our 5-year plan. And effectively, we were saying we were going to grow at a rate of circa 20% a year each year. And we're a year ahead of that plan. So we're 2 years in and effectively a year ahead of that plan. And so we're delighted with that performance. And as we kind of, as I mentioned earlier, when we discussed at the start about a form of a slowdown, we don't think we're going to be growing potentially at that rate this year, probably closer to, kind of 10, 11%. We'll wait and see. We're very early into our fiscal year. But what we are going to be doing later on this year is we're going to be updating that 5-year plan. And so we'll add an extra 2 years onto that plan, basically, and then have another 5-year forecast. I can't tell you what that's going to look like for the moment. We're in the midst of that. In the prior plan, we'd kind of announced different levels of growth for the UK, kind of high single digits through to the US growing at a rate of 25 to 30% a year. And also we've entered the European market. So very pleased with the performance so far. We're 2 years in, but given that we're so far ahead, it's time for us to update that plan.
How does, speaking of the UK, how does the UK compare to other markets when it comes to demand for luxury timepieces? I was reading somewhere that the luxury watch spending per capita in the UK is about 3 times greater than the US.
Exactly. And that's and thanks, Scott. That's a stat we use all the time to promote the UK market. We believe that the UK market is and we would contend, certainly my CEO would contend, that it's probably the strongest and healthiest watch market in the world. And we think that's down for a number of reasons. And if you look at the growth even in the last year to 2 years, Scott, that's been without major tourism. And London obviously is a major tourist hub, but that business was gone for a period of time, obviously during COVID, and the business continued to grow during that time period outside of the lockdowns. And there is no tax-free anymore in the UK, yet the market continues to grow well. So it's a concentrated domestic market. And we believe there's a number of reasons for that. I mean, sometimes it helps if there's a clear market leader in terms of keeping those standards up to a certain level. And there's no doubt that, our group is the market leader there. But there is also, everybody else within that market is investing. So whether it's Selfridges with their distribution there, so they're one of the major department stores in the UK, Harrods, who everybody knows, they've invested, and there's a lot of very strong independents in the UK as well. So, that investment has been going on for multiple years, certainly for the last 8 to 10 years, and that just helps to elevate the market overall. So I think that's been part of the benefits here in the US, and maybe some of it was a little bit when we came into the US market as well, that probably surprised some people that we were coming in. Maybe some people were surprised that we got the support of brands, but I think you're seeing significant investment by us, by other major groups, by a lot of the independent retailers out there who do a fantastic job, and that just elevates the market at an overall level. If you even look at the New York as an example, Scott, we built 2 wonderful boutiques in Hudson Yards and in Soho. Boucherer Turno has renovated Time Machine. Bempe has expanded on Fifth Avenue. There's other businesses that have opened up either in meatpacking or the mono brands that have been invested in. And I think the market as a whole has just grown. So I think we saw that first in the UK, and we believe that's one of the reasons why there's still significant potential in the US.
We'll be right back after a quick break with more of my conversation with David Hurley.
A pioneer in innovative technologies and the use of high-tech materials such as silicium, Ulysse Nardin is one of the few integrated watch manufacturers with the expertise to produce its own high-precision components and movements. In 2001, the brand changed the face of watchmaking by launching the Freak. Freak led a counter-revolution to traditional watchmaking and reshaped the art of horology. Today, Ulysse Nardin remains devoted to its quest for watchmaking perfection through 4 collections: Freak, Blast, Diver, and Marine.
We're back with more from David Hurley. You know, Brian Duffy had said in an interview that the company set its sights on investing in the U.S. because it was hugely underdeveloped because of a lack of investment in retail. What did he mean by that? Was it there was no sort of dominant leadership of scale such as what you had in the UK market?
Well, certainly, when we came in and started looking at the market, it is a highly fragmented market in comparison to the UK, but of course, it's a significantly bigger market. You see the same thing even with the department store groups here. I mean, Neiman Marcus didn't have a store here until 2018, and then ended up closing it. Nordstrom's opened up only, probably 2019, something like that in New York. And these are names that are known across the US, but kind of grew from certain specific markets. This, everybody in Europe, and I'm Irish. Everybody, and so we've got an affinity with the US anyway. We've been immigrating here for hundreds of years, but everybody knows the size and scale of the US, but until you have to travel around it, you really don't get it. I mean, it's just incredible, and so highly fragmented market. No market leader, and anybody who was there at the time, obviously some great independent retailers, but a lot of groups that hadn't been invested in stores, hadn't really recovered from 2008. So the watch retail was certainly underinvested in. And I think some of the monobrand expansion by some of the brands was a reaction to that at that point in time. So whereas other categories, which were controlled directly by the brands like LVMH, carrying which G and LV and Dior, etc., had been building these huge palaces. So I think that was one of the reasons why we really focused in on that market. The differential that you mentioned, Scott, earlier in terms of the spend per capita on timepieces, and then the fact that there wasn't that differential when it came to other luxury categories, made us feel that there was a significant opportunity. But of course, that opportunity, I mean, it was a calculated risk when you're building stores, like Soho, which is 8,000 square feet, Hudson Yards, whatever, 6,500 square feet. There are significant investments to make, so you've really got to believe in the potential. But we also looked at things like the number of watch agencies in Manhattan versus London, and there was significantly less watch agencies in New York, and we just genuinely believed there was that ability to grow it. And we, as you go around the US now, you're continuing to see the watch retailers in the US continue to invest in upgrading or expanding their boutiques. And we believe that will allow the whole market to grow. So that was really the kind of, the crux of us kind of coming over here, identifying the opportunity, was that kind of looking at spend per capita, looking at the stores at the time, looking at the number of agencies that were out there. A lot of the stores were pretty tired. And so I would say even with the vast majority of the stores that we've built here in the US, Scott, I would say at the time, even the 2 in New York, they were, they're significant risk, large boutiques. Now I wish they were bigger. So I think there's been a significant investment now by the retailers itself and by the brands. I think the brands, and you see that in terms of the marketing spend, the resources that they're putting in on the US market, and I think for a period of time that wasn't happening, I think the US gets luxury better than anybody else, but there was definitely some kind of maybe some translation between Switzerland and the US that was missing, or maybe it just wasn't the resources and the marketing that was put into the market. And you see it now, even if you look at things like F1 in Miami, and you see the investments that are made by the brands. I mean, obviously Rolex are always consistent in their investments, but you still see brands like IWC, Tag Heuer, you're making significant investments into these markets, and that's the same for all watch brands. And so, even if there's a slowdown for this next year, I think, our belief is the US will continue to grow if people continue to invest into the market. And we see it in the other luxury categories, Kering and LV, that I keep on bringing them up because you see their stores are going from 5,000 to 10,000 to 15,000. And so big is definitely better. It's kind of a go big or go home strategy.
Right.
And so, yeah, we still, that was the reasoning behind, I guess, Brian's quote.
When you did, start gaining a foothold in the US, and you opened up the boutiques here in New York City and Hudson Yards and in Soho, and then you made these strategic acquisitions for a number of independent US jewelers like Betteridge, Benbridge, Timeless Luxury, and Mayors. When you acquire these independent jewelers, how do they adapt to the Watches of Switzerland's standards of design and client service?
Well, probably the most important thing that we're acquiring when we're acquiring these businesses is the people that work within the business itself. And certainly with the first acquisition that we did, the first strategic acquisition, which was Mayors in Florida and Georgia, what that gave us was a fantastic team. The majority that are still in the business, certainly all of the management team are there, either in bigger roles or maybe in different roles. Maybe they because as our size has grown, maybe they had 3 different roles that they're doing, and now it's just one. But that was great because it gave us a HR team to support recruiting, all of the store development, and just the retail expertise. And the US is different to the UK in so many different ways. The staff, the client base, it's not consistent. So acquiring the staff is probably the biggest thing. So really what we try to do when we have these strategic acquisitions like Timeless or Betteridge, we acquired one store from Benbridge in Mall of America, is we want to try and keep all of the team if we can, take the best of what they're doing, and then support them with our systems, with our processes, and with I guess the strength of our organization behind it. So if you take a look at we'll take the store for Betteridge in Greenwich as an example. It's a wonderful store, great team, but we're going to be expanding that store. We've already taken on 2,500 square feet. We took it on without even knowing what we were going to be putting in there, and we're going to be doing a multi-year investment and renovation in that store, and we're going to keep the name Betteridge. Some of the stores were changing to Watches of Switzerland, but we believe Betteridge has such a strong name in the Greenwich area. So it depends on store to store what you want to do, and that store is going to be very different. It's going to be primarily focused around jewelry because that's the base of the clientele and the expertise that they have. And we're taking our time over the store design. The store itself is already really fantastic, so it's going to be more evolution than revolution. But there's quite a lot of change when we take over these businesses that the staff have to deal with. The first thing is just changing the suite of systems, and whether it's point of sale or all of the other systems that they use. And it doesn't matter whether our systems are better or worse, it's still a significant change. And so you want to make that as smooth as possible. And yes, we want to integrate all of the teams into our business and make them part of the overall business. I think for example, again with Mayors, which is the longest one that we've acquired, they were very proud of being part of Mayors, and rightly so, and what they built. But now I think they would say they're proud of being Mayors, but they're part of the Watches of Switzerland group, and that can only be done over a period of time. That we've got to be true to our word and what we've done, and we do we've done quite a lot of different things with the businesses. We've invested in the stores, invested in the brand relationships, grown the sales, which means that the teams are getting paid well. It's great to be part of a business that's growing. And our size and scale as well means that people can move up through our business. We have the gentleman that's running our Betteridge, the three Betteridge stores today, started off in a store in Northern Ireland, working there while he was in college, and then went to a couple of stores in the UK mainland, then came over and ran Soho, and now is running 3 stores. Our store director from that works in Hudson Yards started off in the credit department in Mayors a number of years ago. So, our size and scale offers those opportunities for people to be able to have real careers in retail. That's a lot of the work that we have to do to try and bring people into the culture is about listening and learning to what the business is today, and not just assuming that we know better, because generally we don't. And then adding, what our size and scale brings, and then being true to our word in terms of backing up what we say we're going to do.
Part of your long-range plan is also to play offense in continental Europe. The company stated it wants the European market to contribute between 5 to 8% of group revenue by fiscal year 26 through a mix of acquisitions and opening monobrand boutiques. Were the conditions similar in Europe as in the US in terms of just underdevelopment?
Yeah, we certainly believe so. We think that the market is quite fragmented, and we think there is opportunities to grow. It's funny that you bring up Europe. We just opened up our first store in Berlin today. I think a Tag Heuer boutique that opened up in Berlin, and we started off in the Scandinavian market because
why did you do that?
We kind of have I guess Brian in particular, but I as well. We have a bit of a history with Scandinavia. We worked for Ralph Lauren. Brian was the president of Ralph Lauren in Europe. I wasn't. I was down the rungs. But the Scandinavian business was a licensee business when we took it over, and we put a strong team in there, and it became as big a region as kind of for Ralph Lauren as kind of UK and Ireland, or the France Benelux region, etc. And so the money is there. The retail isn't always to the same level, and so and the clients are there, so maybe they shop elsewhere. So our first stores that we opened up there is we opened up a couple of Breitling boutiques in Stockholm. We've opened up a mega boutique there as well. We've opened up a couple of boutiques in Copenhagen, and it's been a really promising start. And of course, you learn as you go into these markets as well. One of the things that we've been positively surprised with in Stockholm is just the average price of that we're selling for our monobrand boutiques is significantly higher than our UK or US boutiques. So that's a really positive surprise, and it'll take us time, just like it did in the US, but it's something that we're determined to grow, and we still see significant opportunity there over the next few years.
What do you look for when you analyze a market?
I mean, first of all, it's a lot of those, the per capita numbers that Scott, that even you quoted, is some of the starting points. We obviously look at the distribution that's already there. We take a look at the other luxury distribution that's in place. So, you're not just looking at taking a look at the size of the watch market. You're taking a look at the size of the overall luxury market. And then we compare and see whether it's under-potentialized versus the markets that we're in. And so that's really what helped identify those opportunities. Now, at the start, the first point was, okay, let's take a look at Europe. Let's do the analysis. And then there was, an in-depth analysis done by our team on every one of the markets, the distribution that's there, the sales per capita, and then just a review of the distribution in every country and the quality of it. And of course, there are some great retailers that are working in these countries. But we believe we can add to the overall market as well, and we've got a very strong team And we've got, European-based people that have experience of working in Europe again, because every one of these markets is so different. Scott, we kind of group, we refer to Scandinavia as the Scandinavia market, but Denmark and Sweden are connected by a bridge, from Malmo to Copenhagen.
Right.
But I don't know if you ever saw the program. Maybe it was called The Bridge. I think there was a US equivalent. It was kind of a murder mystery, but as a consequence of the kind of premise behind it was a body being found on the bridge, and the two countries having to work together, and just the differences between the two countries. Sweden and Denmark and Norway get lumped in together, but each one of those markets are very, very different. I mean, just like different parts of Florida and Georgia, etc. So you need the local expertise. You need to learn these markets as well. But we really believe in the potential there to continue to grow the European market through mono brands and through the right acquisitions. I mean, in terms of acquisitions, we're always looking at potentials, but of course, it has to be right for the seller. It has to be right for us as the buyer, and you've got to factor in your ability to be able to execute, and how many things can you do at one point in time. But we're still very optimistic about the Europe market, and think it's going to continue to grow.
Watches of Switzerland has been riding its growth on a multi-channel business model, which includes a combination of multi-brand showrooms, portfolio of monobrand boutiques, and e-commerce, of course. Your multi-brand showrooms represent many of the most sought-after brands on the market: Rolex, Patek Philippe, Audemars Piguet, Cartier, etc. Is there a common design theme in all your multi-brand stores that allows those big brand partners to express their individuality while still drawing the customer to browse through the store and making it a welcome experience?
Well, yes. I mean, there certainly is. I mean, there are certain common themes as you come into our stores. I mean, you would generally find that if you come into one of our multi-brand stores, Rolex, just by the nature of their demand and the size of the business, would probably have the largest space. But we really try to give each one of the brands the opportunity to have its own branding and express itself within our stores, and then we have kind of control the overall look and feel of it. I think Soho, Scott, which you've been in, obviously is kind of a perfect example of that, where you've got every one of the major brands that are there, as you mentioned: Rolex, Patek, Cartier, Ulysses, Nardin. Every one of them have kind of branded spaces, and so they're able to kind of display their timepieces within that. But then the building itself is spectacular, and so the surrounding areas, bar that we have downstairs, the kind of lounging areas that we have for people to be able to sit down, and the overall client experience is what we bring to the table. And I think, but we are constantly taking a look for each store and looking to tweak the design. I mean, the Soho store, just by its very nature and the location where it is going to be very different. The Betteridge store design will be very, very different, because there'll be maybe more of a focus on jewelry because it's a larger part of the business. It's a different area. The building's very different, and so that will be a different design, but a consistency for some of our major brand partners, that we will give over certain spaces and allow them to express their brand. And then there's just a back and forth in terms of things like the kind of logistics of how many seating areas do we want, how many VIP areas do we want, etc. But I think you've constantly got to kind of change and re-look at the store designs as you roll them out. It's easy to get in some kind of a cookie cutter version, so it's about kind of challenging our designers to come up with something different as well, rather than just getting a blank page and going, well, this brand goes here, this brand goes here. It can start to get quite boring. The other thing with the store designs that we try to do as much as possible, and need to do more of, is they're ever-changing stores, because there are always brands that are coming in and going out based on performance or other factors. We have pop-up areas in a lot of our stores. where we can test brands or just, test different, an exhibition with one of our brands. So whether it's first to market, a watch that's just been released. We did one with in Soho with the UN Freak, and so we're able to invite clients there. And then a week later, we opened up a new shop and shop for H. Moser. So we had Edward Malon, who's the head of H. Moser, and really great, charismatic guy. And I think the rise of these independent brands and that are becoming really material brands now, like H. Moser, is just a wonderful thing to see. A really great development to see over the last 3 to 4 years. Or, I think the same night that we did one of those events, we had an event with Bulgari and Aventura. So, and it's getting in special pieces or doing special events with the clients. Having these pop-up areas makes a difference to the store as well. And then sometimes, taking people out of the store and taking over pop-up areas or restaurants and just trying to do something a little bit unique. A couple of years, last summer and the summer prior to that, we had the idea of building out an Airstream and putting it in the Hamptons and retailing out there. And so it was just a fun activity to do something slightly different. We had a marketing campaign at the time called Anytime Anywhere, where we were kind of shooting different brands and in different scenes across the US, and just the idea of a mobile store seemed like a perfect idea at the time, and it was really great fun. I think our clients really loved it.
And monobrand boutiques are also an integral part of the strategy. Many of those partner brands on your roster that I mentioned earlier also have standalone boutiques with operations powered by Watches of Switzerland. There are obviously a number of advantages for luxury watch brands to have their own boutiques, smaller and more intimate, and the customer is completely immersed in a single brand's core proposition without the distractions from, surrounding competing brands. What is the advantage of having Watches of Switzerland power the operations versus owning and operating their own boutiques?
Probably the first advantage for some of the brands is we take on the responsibility for the lease and the staffing. So that would be, there's some financial advantages and so obviously a certain amount of the capital as well. But seriously, I think some of the advantages are, number one, that our core competency is retailing. We're not designing the brands. The brands do a wonderful job. They have their point of view of, the timepieces they design, what the brand stands for. And then, the majority of them, though, of course, some of them run their own retail. A lot of the retail is run by specialists, and that's what we are, and that's what we do. So sometimes our scale can be of benefit. Some of the locations that we've opened up for mono brands as well, one of the issues is that they can be smaller, but then the rent can be quite high for a small space. Sometimes you don't get the best location. Some of these mono brands that we've done in Europe, in the US and in the UK, are maybe 2 brands together or 3 brands together. So that allows for some economies of scale as well. You can still have that overall mono brand boutique experience for a particular brand, but you can share things like back of house. You've got a larger space, so there's some economies of scale in terms of the rent. Maybe there's the fact that you can get a better space because you're now looking for a bigger space. Maybe you're looking for 2,000 square feet instead of 500 or 600 square feet. And, I think, for those brands that we've opened up, those mono brands with both in UK, US, and Europe, I mean, they're certainly happy with the productivity that we've been driving. And, we still, we firmly believe in multi-brands. I think mono brands are complementary. We want stores to be open and welcoming and friendly. And even with that, sometimes, multi-brand stores, even in itself, can be intimidating. And then the mono brands can be another level of intimidation before you kind of cross the threshold and come in. We like to have open door policies, and just having the door open where we can, some security basis, that's just not possible. So I think it's kind of it's a good mix between both. And so whether it's mono brands, multi brands, or online, ultimately it's the client who chooses where they want to shop. When somebody's coming into Omega boutique or a Tag Heuer boutique. Obviously they're coming in specifically to look at that brand, but then people also appreciate with a multi-brand store, there's just that independence of choice, the ability to be able to take a look at a lot of different timepieces, and the ability to be able to compare and contrast. And then just the fact that, with a lot of the multi-brand stores that we have, we're changing the lineup up, or we're having pop-up brands in there, we're testing new things. So there's always something new to show clients when we come in as well.
Who owns the personal data from the monobrand stores? Is it you, the brand, or both?
The majority of it, some of the deals are different, but the majority of the data is held with us.
And what about the role of e-commerce in the Watches of Switzerland brick and mortar heavy multi-channel playbook?
Well, I mean, the e-commerce is, as everybody says, whether it's e-commerce or then people, looking at product timepieces online and then shopping in store, it's hugely important. It's one of the things in the UK where, and this was before my time, the UK business got into that very, very early. They've got effectively a $100 million business online in the UK, and for every one of the brands that we retail online, the online door is the biggest door that we have in our network. So that advertising and the marketing that we do online not only benefits the online sales but in store as well. And so we look at the overall return on that advertising spend, and it helps to drive people into the stores. A huge amount of research is done online, whether it's on our websites, on some of the blogs that are out there. And I think it's, particularly over the last 5 to 6 years, it's resulted in a sea change in business. I don't know whether wonderful brands like, MENF or even a H. Moser, have benefited so much from online, from social media, from Instagram, etc. 10 years ago, if you were launching a brand like that and you wanted to turn it into something meaningful, people would say, well, you've got to go out and spend a huge amount of money on print advertising, on billboards, etc. So it's not just the online websites itself. Social media is so important these days for getting to the right clients. We continue to believe in online. We continue to believe that it's going to grow, but it's part of the overall ecosystem.
Fiscal year 23 was a record year of revenue and profitability for Watches of Switzerland, thanks to surging luxury watch demand. However, many feel the epic run on luxury goods is finally hitting a speed bump, and aspirational shoppers in the U.S. will soon be forced to trim their spending. Are you concerned about softening demand in the U.S. for luxury watches, or do you think the top end of the market will keep things humming along?
I think that there's certainly been a slowdown in the growth, Scott, over the last 7 to 8 months. There's been a form of a slowdown in the growth, but that just wasn't sustainable, the kind of levels of growth that were there. And I think it's down to a more sustainable level now. I'm not concerned in the short to medium term in terms of what's going to happen to the US market. I think the fundamentals here of the US economy continue to be strong. Inflation seems to be coming at least a little bit more under control. The overall stock market is very strong here in the US, which obviously affects people's financials as well. And I just think that the watch category versus other luxury categories still has the ability to gain market share. People are choosing timepieces versus other luxury categories. Whether it's again hard accessories or jewelry or holidays, and so we've just got to continue to invest in the US market, and I think over time it's going to continue to grow. We got to stay the course, Scott. Yeah, and I think look, we're still of course you want to continue to be growing at the levels that we have been, which have been incredible, and but I still see this market continue to grow over the next few years, and I think we're continuing to invest in renovating stores, in opening new stores, and we're going to continue to do that over the next few years. I mean, we have store developments now going. We're kind of with our partners, because again, with just our ability to execute, their ability to execute, constraints in the supply chain. We're now planning projects in calendar year 26. So we've got projects laid out through 23, through 24, through 25, and we're already even looking at 26. Yeah, we plan to continue to grow, and I think the overall watch market in the US will continue to grow. And if there's a couple of bumps along the way, well, that's to be expected. But over the sustained period, we expect it to grow.
And new consumer segments, including young people, women, and consumers outside of the US and Europe, seem to be leading the charge of this massive upswing in the luxury watch market. We're already seeing big luxury watch brands like Audemars Piguet and Cartier and others embracing youth culture and new audiences with various targeted programs and campaigns. Have these new audiences and their priorities changed the way Watches of Switzerland does business?
Yeah, of course, it changes it. I think we're seeing our clientele continue to get younger in some of our New York stores. I'm 49 today. I'd like to think I'm ageless, but I'm probably in there on a Saturday, and I'm by far, one of the oldest people in the store. And that's great. I think that the younger clientele are interested in sustainability. They're interested in things that are going to last for a period of time. They're not just interested in those luxury watch models that are super scarce or super high demand. They're interested in horology as a category. They really are. They're interested in brands from from G-Shock through to the whole way through to Patek and every brand in between. And that's really fantastic to see the passion that they have for it. And I think it's, a combination of I guess researching online, this interest in sustainability and things that, with everything else so redundant as we discussed, like iPhones and Apple Watches, everything being so redundant, something that lasts is something that I think is becoming more and more important to people. And then you've got a lot of the online blogs, the Hidinkis of the world, Watchinista, all of these groups that I think have serviced that interest as well and have done a great job. So I think that's in particular in the US and growing in the other markets. And of course, that's something that each one of the brands wants to tap into as well. And I think that's one of the great things that with the multi-brand stores that we have is that we do want to have those accessible price points as well. We're not selling everything at 50,000 or 100,000. We want to have it at lower price points and keep some of those brands in the store to make sure that we are able to cater to some of those younger consumers. Though some of those younger consumers are also interested in the real and are purchasing the luxury high-end timepieces.
So what are some of the more interesting consumer trends that you're seeing from all the customer purchasing data that you've been gathering?
Well, we monitor trends on everything from size of cases, watch cases to colors, etc. I think the biggest one that I've seen, at least based on the client data that we're seeing, is just the rise of some of the independent brands, which I think is fantastic.
Yeah.
The interest in brands like MB&F, H. Moser, Chapek, which is a brand we don't retail today, but Speak Marine, Arm & Strom is a brand that we retail that I really love and really believe in, and people are really interested in these timepieces. And I think the major watch brands do a great job, but I think that ability, for example, I said that for H. Moser and Edward, who you interviewed on your podcast. The ability to meet the person that's behind the brand or the person that designed the timepiece, I mean, that's a really fantastic thing. And I think, people like Edward, Max Busser, I mean, they get treated like rock stars by the watch community. And so, I think that's really wonderful to see with these brands that, not those two in particular, but other independent brands over the course of the last few years that, now their biggest issue is, can we make enough timepieces, or we don't have enough watchmakers?
Right.
Well, that's a fantastic problem in comparison to maybe, some of the challenges that they had in the past in terms of just being able to get their timepieces into stores or to be able to sell them to the final consumer. And it's just a wonderful thing to see.
Yeah. Do you think your smaller independent Swiss luxury brands, all the awareness that they've gained, do you think a lot of it had to do with the rampant supply shortages of the big four brands? So they turned their attention to other brands?
I think that was only a small component of it. I think genuinely, I think the social media, Instagram, the ability to be able to, for these watches to get seen by so many people and shared across social media, I think that's made a big, big difference. First of all, I think some of the marketing that gets done by some of these brands, even some of the marketing that H. Moser did back in the day was real guerrilla marketing.
Yeah.
But they'll take, but they'll and it's kind of changed over time. But they still do some really interesting collaborations, which for the watch, there's watch as well. I think with a collaboration with the Armory, they did. I want to say, was it Undefeated? Was that the brand that they did a timepiece with as well? A kind of a streetwear brand, and I think that's great. I think that really helps drive interest because it's something a little bit different. So I think the advent of kind of social media and online blogs, and maybe there is, sometimes from time to time there's some frustration that people can't get the timepiece from the big four brands as you mentioned, but I think it's just a wider interest in timepieces in general. They're not just interested in one brand or one trophy timepiece, and that's just a change in the consumers, and it's fantastic to see.
So, David, what can we expect to see from Watches of Switzerland in the second half of this year? New expansion markets, you mentioned Berlin, store openings, acquisitions, brand partners, anything new that you can share?
We are, continuing to invest in new stores. We just opened up a month ago, so in the American Dream project in New Jersey.
Right.
We signed up to several years ago as naive foreigners. As soon as we heard it was called American Dream, then we said, okay, we've got to sign. And but we love the project. We love the family that are behind it, and the same group that are behind Mall of America and Edmonton Mall, and it's just it's based around entertainment. That whole project, and I think it's going to be really great. And I see you see that in a lot of just the trends of retail that are out there. The other locations that you mentioned the Timeless acquisition that we did in Legacy West in Plano, Texas. That mall again is kind of an outdoor mall, but it's based more around entertainment and restaurants than retail itself. And it's that's what draws the people there, and then they choose to retail again. So more stores. The next store that we're looking to open up in probably the second half of our fiscal year here in the US, or the next major store. We've got some mono brands that are opening up as well. We're opening up in One Vanderbilt. I don't know if you know that building next to Grand Central.
Yeah, right. Of course.
So we're opening up.
Beautiful.
We're opening up a Watches of Switzerland store there, and so we're really excited about that. Some other projects that are going to be kind of opening up later post that. We are going to be opening up. The timing still needs to be confirmed. We're going to be opening up the largest Rolex boutique in Europe in London on Bond Street. We already run the Rolex boutique there, but moving to a bigger location. And then we've got some marketing plans that are in the offing as well. Some really interesting stuff that can't talk about at the moment, but some kind of an update to the Anytime Anywhere project that we did. We're shooting some of that stuff right now. I just came from one of the shoots yesterday, and that's going to be really exciting. Maybe something a little bit different in terms of our partnership with the brands again. So some fun stuff to come.
David, my final question is the luxury item question, which I ask all my guests. So if you were stranded on a deserted island and you could only have one single luxury item with you, what would that luxury item be? It can't be any form of air or water transportation to get you off that island or anything that requires mobile service, so you can call somebody to get you off that island. It's just you, lots of sand, lots of palm trees, lots of ocean. What would that one single luxury item you would like to have with you?
Well, I don't know if this is going to fit into the category, so you're going to have to let me know whether this fits in or not. But I'm a huge fan of music. I've got I collect records. I've got
The vinyl collection.
Vinyl collection, like 10,000 records, something
Yep.
like that. So I don't know if I'd be allowed to bring my full vinyl collection and my turntables and the turntable, but at least a turntable and some selection of vinyl. If I'd be able to have that, then that would probably keep me pretty happy. And if I had my whole vinyl collection, I'd be very happy there, just flipping records and changing sides every 20 minutes would work for me.
David Hurley, Deputy CEO of Watches of Switzerland. Thank you so much for joining me on The Luxury Item.
Thank you very much, Scott. It's been a pleasure.
That's it for this episode of the Luxury Item Podcast. Thank you so much for listening. If you found this useful and entertaining, I would be really grateful if you can share it with a friend or colleague. I would love it if you subscribe so you never miss an episode. And while you're there, be sure to rate and review us on Apple Podcasts. It really helps other listeners find us. The Luxury Item Podcast is a production of Silvertone Consulting. I'm your host, Scott Kerr. Until next time.